One of the biggest changes announced in this year's budget was the proposed establishment of a secondary market in annuities. Now, whether this comes to pass or not will depend on the results of the election, but we do have a consultation document to consider, and it's around about 30 pages. It deals with three key aspects: the commercial aspects, the taxation aspects, and consumer protection. Now, on the commercial front, it's buyers and sellers that we need to consider first. Who are going to be the buyers of these annuities? Well, institutions only. This isn't a market that's going to be established between individuals. So just institutions, and not the institution that sold the annuity to the individual selling in the first place. These sellers are of course going to be around about 5 million people with annuities. Not all of them of course, but some of them will be wanting to sell that annuity. In relation to the price, then the factors that will need to be taken into account will be of course the risk that the buyer of the annuity will be assuming. It's one thing to have medical evidence suggesting how long the individual with the annuity is going to live for. That's one thing, but of course life is unpredictable, so you are taking on a risk that that person will die earlier than was predicted and your return won't be for so long. There'll be frictional costs and of course the need to make a profit. So the individual sellers of these annuities may well be getting a little less than they expect to get in the first place. That's something that of course the market will have to take account of. Then when we look at the taxation aspects, the biggest barrier to overcome was the money that you received from the sale of the annuity would have been because of an unauthorised payment, and that would have given rise to a 55% tax charge. It's proposed that the amount will be taxed as their income in the year they receive it. So it's quite like this point of taking your money from your annuity pot in cash and the warning that it will all be taxed in the year you take it. It will be the same for the sale price from the annuity. But of course you don't have to take all the money in cash. You could take the money in the form of a drawdown contract or in the form of a flexible annuity, in which case then you'll be taxed when you actually receive the money. So the key point is you'll be taxed at your marginal rate or rates when you receive the money on the money that you receive. If it's a lump sum, you'll be taxed on it all. So the taxation will be overcome. It won't be 55, but for some it could creep up to 45% if it's a big amount of money received. The last part, of course, is consumer protection, and that's where there's been a lot of fear. Will people understand what they're doing? Will people unwittingly sell where they really shouldn't have? So there's going to be masses of risk warnings required. There's going to be a lot of regulatory involvement. Perhaps the most important point from an advisor's standpoint is that it's proposed, I think, in the document, the consultation document, that for annuities worth more than 30,000, it will be mandated that you have to receive independent advice before you make the sale. So that probably means quite good news for advisors, another area of business to be involved in. But the key thing here is we're going to have to wait, and post-election is when we're going to have to wait for to see if all of this comes to pass.